Good afternoon, traders. Hope you guys and girls are doing very, very well. Give it a few minutes as always. Good turnout, which is good to see. So this is a new addition to what we have originally with the webinars. Of course, you have, we do the advanced webinar on the Monday. We do calls on Tuesday. We then do the members webinar on the Wednesday. Obi does his on Thursday. And I'll be now doing my webinar on a Friday at 12. So there's obviously going to be a lot of, a lot of things going. But I think it's good for those traders who are very new. Obviously, this is going to be this webinar is going to be for those who are very new to those who are very more advanced. But ultimately, it's in my opinion, it's all about relating back to the key aspects of trading, which we'll definitely talk about today. Building your view, knowing building a plan around it, having a strategy to execute trades, and then knowing what management style works the best. It's easy in theory, easy to say, but then obviously you want to use these webinars to sort of express it in a way where we can actually build a plan for the upcoming week, next week, and then at the same time sort of see what we have done if markets are following the plan. A lot of them, we'll talk about cable, we'll talk about various markets today. Cable's definitely market higher on that list following the plan. I just want to talk today how we get to those, how do we get to the outcome? What was the decision-making process in order to get to that stage? So hopefully this will be useful and of value to those who are very new. Something that's a bit different to the webinars that we do is the advanced traders will have input in regards to what topics we talk about. So today, by a quite large amount, we're going to be looking at price action. So we're going to talk about price action, how we can make sense of price action. I just had a conversation with someone actually where what we spoke about is rather than reacting to what we're seeing, rather than just reacting to what's given to us, it's far better off actually having a forward-looking view, understanding what's most likely going to happen based on probability, and then understanding what price action should be associated to that plan. So, like I said, pound dollar is a great example of that, which we'll dive into as well. So yeah, a lot of the agenda today. And we shall be getting started now. So yeah, a lot of new names, which is good to see. So if you are new, there's a Q&A section. So if you don't want, if you want to ask a question without, not that anyone does, but if you want to ask a question without a bit of judgment, like I said, no one does. But if you just want a bit of anonymity or a bit of privacy with the questions, you feel free. There's a Q&A. There's a Q&A. Oh yes, there's a Q&A section, so you're more than free to ask your questions privately if you wish. But yeah, a lot of new traders. So, really, guys, so we're going to get straight into it. And like I mentioned, a lot of new traders. So I just want to introduce myself to those traders who are very new. Brilliant. So very recently, I've attained the level 5 financial market trading qualification. So this sort of varies into financial assets, financial products. So level 5 is the same equivalent as the undergraduate degree equivalent qualification, and also an associate level grade with the CISI, the China Institute of Securities Investment. So those are the sort of qualifications recently obtained in the last couple of weeks. For those who don't really know a little bit more myself, started trading with the company at 17, 18, joined the company at 19, 23 now, and I manage a few different accounts now. That's just a little bit about myself. We're gonna get straight into the chart, and I think what's worth sort of looking at first is just what our approach needs to be. In my opinion, at least, what we need to look at when we look at charts, what approach we need to have. Thank you, guys. I appreciate the comments there. So yeah, for the first we need to focus on is what approach needs to be in the market. If you're a very new trader, and I ask this question all the time, and it comes down to two key things, right? Number one, looking at the markets randomly in terms of looking at the assets just one by one down that list, and the biggest one really is looking at the market with our strategy, looking at the markets with the view that we need to look for a trade. And do you know what? I wasn't really planning this, but let's play this situation now. So I'm going to pull up a slide and highlight what may happen if we continue to do this. I mean, let me just put a quick poll. I want to make this webinar as interactive as possible. Um, just a very quick yes. I'm going to make a poll in a minute. I'm just going to load up the slides. Just a yes or no. So the question is, who looks at the charts with the objective of looking for trades first? So I just want you to be as honest as possible. The question, as I said, is who looks at the charts with the objective of looking for trades? So, when you go to the markets, looking for trades is the priority. So I'm just going to put that poll. It should be on there. Do that. So how do I? Right, there we go. Should be up. Should be up and running now, just live. So about 100 something people in here. So let's try and get as much interaction as possible. So the question is, when you first look at the markets, what is the objective looking for trades first? So when I say look at the markets with the strategy, looking for opportunities, just a very quick yes, no answer would be great. Uh, okay, so sort of 50-50 at the minute. Very much leaning more towards the yes, and I suppose that's because of a lot of new traders, which is expected. And what I want to highlight very quickly is what may happen if we continue to look at the markets in this manner. So yeah, definitely leaning more towards sort of fairly 50-50, but yeah, definitely leaning more towards yes. So yeah, I want to highlight this example of what may happen if we continue to apply the market or look at the charts in this way. So let's say we look at this market, pound CAD, and here's the chart. Let's do our technical analysis, right? So number one, the markets are in an upward moving trend. So the buyers are in control. Great, brilliant. And for those who know the strategy rules, this area meets the rules, right? That's a nice big old buyer's bar. The moving averages on the right order. The RSI would be pointing higher, right? So the point of this example is to highlight that there's no reason for us not to place a trade, right? If the buyers are in control, which from the uptrend it looks like they are, this area meets the strategy rules. Why would we not place a trade? We would, right? We certainly would. And so from the poll, it would suggest that a lot of you would, right? So let's say we do, right? There we go, brilliant. We placed the trade and we're in the trade live. Okay. Okay. So the key point in this slide, right, is to highlight that we haven't looked at the major markets once, right? This is a pound CAD, this is a cross pair, right? The major markets that make this pair possible is both the pound USD and the dollar CAD, right? So if the pound USD is going down, what does that mean? Well, that means the pound is weak, dollar strong, right? So that means pound is weak. Okay, great. If the dollar CAD is also going down, that means the dollar's weak and the Canadian dollar is strong. So that would mean pound is weak, as we said, CAD is strong. Therefore, this market would be going downwards, right? Which is a contradiction from what the technical suggested, right? So if we do a quick recap, what we looked at first was the technicals, right? And the technicals are suggesting price is bullish and we placed the trade, right? Why would we not, as we said? However, the major markets, which we didn't bother to look at, is actually saying price is going down. So we have a massive, massive conflict, right? Does this make sense so far? Especially for those who are new, because there are, the answer was majority yes, and I imagine those are very new. So this is sort of very directly speaking to those traders who are very new, right? Great, brilliant. So moving forward, what's going to happen? Well, this market price is going to go down, right? Why? Because the major markets say so. So even though this area meets your strategy rules, it's a losing trade, right? Okay, so what went wrong? What was the problem? What was the Right, what was the problem? So number one is we did not follow the market in the correct order, right? Sometimes we look at the chart, I know especially new traders will go to the market, go down that list one by one, randomly looking for trades, right? You can see we looked at pound CAD first. Pound CAD is a cross pair, right? Why would we look at a cross pair first? It makes no sense, right? We need to look at the market in the correct order, which is look at the dollar index, look at the major markets, in order for us to actually understand how each individual currency is truly performing, right? That's number one, right? Making sure we look at the market in the correct order. The second point, and arguably the most important point, and the whole point of me highlighting this example, is what our first initial goal is when we look at charts, right? Let's say you have two traders. Let's say you have trader one that looks for trades first. 53% of you say that you do. So this is very much applicable to those guys and girls who said yes. Let's say we look for trade first, opportunities first, right? We'll see from that previous example that we just looked at, this trader has everything that he or she needs, right? However, it's led to a losing trade, right? Okay, great. That's trader one, right? They're looking for trades first, and that's the outcome. Okay, great. Let's say trader two now, right? He or she is not looking for trades first. They're very simply looking for market direction. They're trying to understand how the currencies are individually performing, right? Well, this trader understands that pound is weak, CAD is strong, right? Therefore, this trade doesn't take that trade, even though it meets the core rules to buy, right? The point I'm making is both traders have access to the same information, right? The same market, same everything, but they've come down to two complete different outcomes. Okay. Is this making sense so far for those who are very new, those who answered about 2%? These are, in my opinion, the two main key errors, let's say, right? Brilliant, perfect. So we've gone through the problem, we've gone through the issues, the 2 points. The ultimate question now is what is the solution? How do we make sure we avoid this happening, right? But also find the best opportunities, okay? So let's definitely go through that. Base on the left, quote on the right, market's going up, base is strong, quote is weak, vice versa when it's going down. Okay, brilliant, perfect. So again, like I said, I want this to be as interactive as possible. So here's dollar JPY, the markets are going up. So which currency is strong, which currency is weak? Just very quickly, if you type in the chat, which currency is strong, which currency is weak in this example. Right, dollar strong, yen weak, USD strong, USD strong. Perfect, brilliant, perfect. We're in the yen weak, perfect. We're definitely in the right direction, right? Dollar strong, yen is weak. Now the question and the key question here is why are we here, right? We're first, let's just imagine we look at the charts for the first time and this is what we're presented with, right? The question is why are we here, right? Well, look, we're not looking for a trade, right? When I, quite frankly speaking, say I don't care what the strategy is doing at this point in time, I say that because I'm not looking for an opportunity. I'm not looking at the moving averages. I couldn't care less about the crossovers because I'm not looking for a trade, right? Our initial goal needs to be gathering information, right? This is the major market for the Japanese yen. As we've highlighted, yen is weak, and that's the information that we take away, we note down on a piece of paper, right? Whatever works best for you. Brilliant. Let's do another one, right? Very quickly, Aussie dollar going up. Again, which currency is strong? Which currency is weak in this example? It's very quickly in the chat. Aussie strong, dollar weak. Perfect. Brilliant. Perfect. Again, why are we here? We're here to understand what the Aussie dollar is doing, right? Brilliant. Now, we do the exact same thing for all the other major markets, euro, pound, dollar, dollar CAD, dollar Swiss, right? We're just going to have a look at the two markets we've just spoken about. And this is the question I want to ask. And this is where we look at the USD, right? By the way, this is the same time, same date, same time frame, right? So we're looking at the same perspective at the same time in the markets. But the dollar is both strong and weak at the exact same time, right? So my question now is, why is the dollar strong and weak at the same time? Both answers are correct, but why does this happen? Again, another poll. very quickly, and I would like to see as many people, yes or no. It's just a yes no. It's just a yes or no answer. So just yes or no, or oh, let's just say choice one is yes, choice two is no. So just again, choice one is yes, choice two is no. Just as many. Choice one is yes. And by the way, the question is, do we know why this is happening? Okay, so do you know why this is happening? Choice one is yes, choice two is no. I Okay. Okay, so majority starting to swing to majority starting to say no. Okay. Okay, brilliant. But you can see why I've asked the question, right? How on earth can one currency present strength and weakness at the exact same time? Right? How is that possible, right? And that's what we're gonna get into, right? So this is why we need to look at the dollar first. This is why the dollar is at the top of the triangle, obviously get into it. But let's just use the dollar as our indifferent currency, as our benchmark, right? So let's say we put in the middle as our indifferent currency, right? What we know and understand from what we've gathered already, right, is the Australian dollar stronger than the USD. So I'll put that on top. Brilliant, perfect. The dollar is stronger than the yen, right? So I'll put it below that. We already know this. We just went through the markets to gather this information. Okay, great. The point I'm making now is if the Aussie is stronger than the USD, dollar is stronger than the Japanese yen, that must be the Australian dollar is also stronger than the Japanese yen as well, right? Based on this relativity of strength. So you can see the point I'm making now is we've never sort of got to that conclusion had it not been for the dollar. And that's why the dollar sits at the top of the triangle. We need to know what the dollar is doing so we can reference that performance against the other currencies. Okay. Brilliant. Hopefully this is making sense. Let's move on, right? So what would happen now if I put the Australian dollar and the Japanese yen directly against one another, right? As we just said, the Aussie would be a lot stronger than the Aussie would be a lot stronger than the yen. That's great, brilliant. Our cross pairs are made up of the major markets, right? You can see we focus our attention on two major markets, the dollar yen and Aussie USD, right? If I put those two majors together, that creates Aussie JPY, right? I'm not going to make a poll for this, but very quickly in the chat, without looking at the chart, right? We can't see the chart, right? But what direction should this market be going in, right? The key point is we haven't looked at the charts. We don't know, we haven't seen Aussie yen, but what trend should we be in? Okay, majority is saying up, right? Great, brilliant. The point is, right, we've understood the direction of this market without even looking at the charts, right? Because we are indeed in an uptrend. But the point I'm making, I think a lot of you understand this now, is we already knew that. Okay. So you can see and by the way, you can see we haven't randomly gone to Aussie JPY. We haven't said, let's just look at what the end pairs are doing. You can see we've been guided as such to the end pairs via the major markets by making sure we look at the correct market in the correct way. And by the way, you can see as we've gone through the solution, I've not even said the word strategy, right? The time that we did talk about strategy, the time that we did mention the strategy as our primary goal, you saw what happened. It was a losing trade, right? So just as a quick recap, what we need to do first, and you can see what we've done here, is we've understood how our currencies are independently performing. See, we've done that via the majors, right? Aussie dollar and dollar JPY, right? We've then used that information to build a watch list. By the way, Aussie JPY, go on that watch list, we could be pen and paper, right? We then do our technical analysis, which we can certainly get into as we look at the charts later on after this, example here. But the point I made, especially for those who are very new to trading, if you're a new trader and you're sort of struggling to know what should I do first, what market should I look at, what's my primary goal, right? Hopefully, this has given you that perspective of looking at not only what you need to be doing, but also most importantly, why you need to be doing it, right? Looking at how our currencies are performing, building that all important watch list, later on doing your technical analysis. But you can see what we assume we should be looking for first, which is maybe strategy and trade, in reality is actually the last thing we need to look at. Okay. So for those who are very new, is this making sense? Is this giving you sort of a new perspective at least in terms of how you should be looking at charts moving forward? Brilliant. Perfect. That's really good to hear because look, the reason why I brought this up in the first place is sort of to set the tone when we look at charts, what the goal needs to be, why we look at what we look at in the order that it needs to be looked in. Um, Brilliant, perfect. No, that's really good to hear. And like I said, this is more directed to those who are very new, for those who are maybe intermediate level that sort of know this, but maybe struggle with the implementation of it. Because look, on paper, you could be the best theoretical trader in the world. If we then don't know how to use that information to actually find good markets, find opportunities, right? That's where we're going to struggle. So, brilliant, perfect. That's good to good to hear. Okay, that's a good question. How do we know it was in an uptrend? So that's a very good question, right? So let's go back to the very beginning, right? So what do we know? We know the Aussie is the base, and we also know it's the stronger currency. Great. We also know yen is the quote currency, and it's the weaker currency, right? Now, for a forex market to go up or down, right? In this example, right? For a forex market to go up, the base needs to be strong, the quote needs to be weak, right? The point I was making then, and it looks like a few of you understood it, right? Is by understanding what is strong and weak and what is positioned, which currency position in the location it's in, we should theoretically be able to understand the direction of the markets are going without looking at the markets. Does that make sense? Just that last point. Um, if it doesn't, it's not a problem. Obviously, it sounds like it might be a bit fairly new. Um, okay, not a problem at all. But look, the main point is you can see we haven't gone to the market looking for trades via the strategy. It's about looking at how the currencies are independently performing, building that watch list, and building those technicals. Brilliant, perfect. So right, uh, I can definitely send this presentation over after this webinar. We'll do that at the very end. But I would like to move on now from that and start to talk about our approach. So I hope that sets the tone. Like I mentioned, it's good to see that it gave a few new traders a new perspective. What we're talking about now is the life of a trader. And this is very important to understand. And I'll tell you why, because when we go to the market, we need to make sure we're hitting all the key bullet points or key points in this logical order, right? So number one, my opinion, the very beginning of the trade needs to be your market bias, needs to be our view of the market. By the way, today's not just going to be all theory and just everything thrown at you. We're obviously going to look at some examples. Pound USD is going to be our market example we look at. But what we do, number one, is we need to build our market view, and this consists of three things, in my opinion. Right, number one is the asset class, making sure we get on the right side of the market. Right, you'd be surprised how many times you might place a trade, buy or sell. You look back at it and say, hold on, why on earth was I buying or selling, right? Every single trade has been there, right? All of us, right? At the very beginning, different stages. So the point is we need to make sure the right asset class, right? So let's talk about this hypothetical example. Let's say we are in a market uptrend, right? So very clearly we want to be a buyer, right? That's very easy, great, good. The second point now is the context of the market, right? Where are we within the actual context of that chart? We are in an uptrend, we want to be a market buyer. However, you can see the context is we are in a phase two, right? So if we are in a phase two, although yes, we want to be market buyers, the context is incorrect to actually place any buy trades, right? Which leads to the last point of timing. Okay. So the timing's wrong. The context, look, I want to be a market buyer, we're in an uptrend, great. The context, however, is we're in phase two. So it's not the right context to be an active market buyer. Therefore, the timing is incorrect. Therefore, we cannot actually place trades, right? And the point I'm making is we've made that decision not to place trades, not because of the strategy, but because of our view of the market, right? So you can see how important this needs to be. In my opinion, you need to spend almost 85% of your attention on this number one point, right? So let's actually look at an example, right? Let's actually put practice in theory to practice, and let's talk about pound USD, right? Now, like I mentioned, this could be this webinar is ranging from very beginners to intermediate advanced, right? And the main point of this is more process driven, why we get to the outcomes that we get to. So here's pound USD, right? The first goal, as we just said, is we need to build a view of the market. That's our primary view, right? The first point is the asset class. Should I be a buyer of the market or a seller, right? Now, there's so many different ways of actually getting to that goal. For me personally, seasonality is a very, very important tool. Um, Now this is the pound dollars seasonal chart, and you can see it definitely suggests that as we enter the end of this month, start of February to March, historically speaking, cable underperforms. So straight away, I've got a view that historically over the last 20 years, pound underperforms during this period of time we are entering. Obviously, today's the 31st of Jan, right? We're in that seasonal window, right? So that straight away gives me an idea of what the price may do based on historical performance, right? Okay, great. What now I want to do is look at the trend, right? I will look at the market trend. I will look at what sort of trend we were in. We are very clearly in a downward moving market. Okay. So I want to be a seller of this asset class. Great. The second point, as we mentioned, is the context. What's the context of this market, right? And you can see there's a lot of squiggly lines, there's a lot of lines on here, right? But again, like I said, the point of this whole webinar is process-driven outcomes, right? So what I've done very simply is measured this previous phase one. I've then taken it from the phase two to give me an idea of how long the phase one, the next leg may be. And you can see the size is remarkably very similar. Not the exact same, never going to be 100% the same, but you can see roughly speaking, the market phase is very, very similar, right? What I've then done is looked at the phase two and measured from the bottom to the start, and that's given us an idea of how long this phase two can last, right? Like I said, the topic of today is price action, which we'll definitely get into. But we can't understand price action without understanding context, right? Now that we know this is very much the phase two of the market, we can see that the price action that we're seeing makes a lot more sense, right? We're seeing very strong buyers. But as we enter this seasonal window, as we enter what seems to be the end of phase two, we're seeing those buyers starting to really lose the steam, right? So this price action that we're seeing, hopefully it makes a little bit more sense now, right? Because we know what this area means related to the actual chart, right? Just give me yes or no if you're still with me on this so far. I know there's a few questions about seasonality, which we'll talk about later on. But is this making sense? Just measuring the phases, measuring the phase twos. Yeah. Okay. Great. Brilliant. Now, like I mentioned, you always want to have a forward-looking view, right? So you can see I've justified the previous lines. Great. Brilliant. Perfect. What do we do moving forward, right? You can see what I've done here is I've measured that previous phase two and lined it up with where roughly the phase two should end based on what price done before. And that's give me a rough idea of how long the next move to the downside might be, right? It might be this length, it might be slightly low. It just gives you a rough idea, right? But at least now I have sort of a blueprint of not only what price may do moving forward, but I sort of know where I am now, right? Which is very simply in a daily turning point, potentially moving on the way down. So this market is very, very close to being a tradable market, right? But I want to emphasize for those traders that are very new to this, when like I said to you before, the question when you go to the market is, what should we do? How do we analyze charts? What's the first priority? All of this, better yet, let me just get rid of the moving averages, right? All of this is done not on the strategy, not with the goal of looking for trades. It's the first one of, right, where do I think the markets are going to go? What's my view of the asset? Right? As a trader, you make money what's going to happen. So we need to have a forward-looking view at all times. Okay, so brilliant. Now, this, of course, where you are very new, you want to start to know what the market characteristics are like, right? So what do I mean by that? So we know the context at the minute is we are at a daily turning point, okay? So as a broader point to make, just pause and broader point, if you are very new, you want to start to understand what price does in certain areas, right? Let's talk about this daily turning point, right? And by the way, this is applicable to any market, not just the pound dollar, dollar index, there's a lot of equities, things like that. What does the price do at turning points, right? Yes, on occasion it might go down and up and from down, but on other occasions, look, it might range for a couple of days, right? We can see a bit of a few days of consolidation before we actually see the market crack on, right? Now, as a trader, look, I don't have a crystal ball to say, right, markets are just going to go down like a stone. What we do need to do, however, is understand the most likely situation to occur, which it might be a daily range, it might be the price go down, and understand what price should do in those situations. Well, like I said at the very start, the theme of today in terms of the educational topic, which hopefully we have time to get into, is price action, right? So now that I know I'm at a daily turning point, you want to get to a stage where you sort of understand what patterns should occur in that area, what price action bars you should see in that area. Now, if you just simply don't know, a great thing to do, right? Markets repeat themselves, is to go back to a similar stage and just sort of ask the broad question, right? What did price do here, right? Because what's happened here effectively, price has gone up and down, is what potentially may happen, right? So what's happened here is what we want to see happen here. So let's actually look at it, right? Let's actually look at this turning point and ask the question, what happened? Right? Does that make sense? Does that you still guys with me? I don't want to go at light speed pace and we're not following, but let's go back to it. So what you're seeing here, highlighted by the boxes, phase two on the daily, moving to phase one, right? And what we are seeing here, phase two on the daily, then move back to phase one. So what's happened here, like I mentioned, is what we want to see here. So let's talk about it, right? So what we are seeing, high highs, high lows, that's step one, right? Uptrend. Markets break the trend and then we range, right? Remarkably, you see what price has done here is very similar to what price is doing right now, right? Like I said, markets repeat themselves, right? We're on an uptrend. Markets are also in an uptrend here. Great. Markets then ranged. You can see markets are ranging, right? So far, markets are doing almost the exact same. So the question now is, right, what did the price do from the range and to go down? What bridges that gap? What did the market do to go from a range to ascending lower, right? Well, what you can see is price has broken out of the range. It's then come back to test the lows of that range, and down we go. The solution is very simple. It's the cycle, right? So where this is the solution to effectively this problem we're trying to solve, which is what's the gap between the range and the markets going down, we want to look for the exact same thing here, right? So if we zoom in here, what we are now looking for is a break, a retest, and down we go. We want to look for a cycle. That's essentially what we want to look for. That is the plan moving forward. So up until that point, unless the market does and follows that plan, everything else is just noise, right? If the markets might sort of range high like this or just continue to range, the point is you want to have a crystal clear plan of what it is you want to look for and actually have that plan. So brilliant. Does that make sense, by the way, just on that point? Yeah. Brilliant. That's really good to see. So, okay, on that question, it looks so easy to spot when you can see the past chart pattern. I just really struggle to see it as it's happening. Okay, that's a good question, right? And let's talk about, because essentially what we're looking for is reversals here, right? But let's talk about what actually happens and divide it into stages, right? So let's say we have a market uptrend. Let's say that's stage one. Great, brilliant. Let's say the market breaks that trend, right? That's stage two. Okay, great. Let's say then the market makes low lows, low highs. That's stage three, right? We have now just made an inverse head. We've just now made a head and shoulders pattern, right? But the point I'm making, you see, I haven't gone to and said, look, here's the head and shoulders. By dividing it into three sections, right? You will now be able to track where you are from the uptrend to the breaker trend to the new trend, right? And that's sort of when the market reverses. So let's go back to where we are and actually look at where we are. So you can see markets were making high highs, high lows. Let's just get rid of this actually. So you can see markets making high highs, high lows. There's stage one. The markets now have very much broken trend. We're not making high highs, high lows anymore, right? Yes, you could argue we're not really making lows, low highs. But the point is, at least I know where I am, right? Which is, yes, we're not ready to place trades right now, but we are very, very close. We're almost halfway there now, right? So I think that's a good question. I think that's a good broader point to make as well for the majority. Try to split what you're seeing into sizable chunks. I mean, it's like anything in life. If you're trying to achieve a goal, right, you don't just think about where you are now to achieve the goal. You sort of break the goal down into small, bite-sized chunks, and you just hit the goal one by one. Or if you're studying for exam, you're not just going to read the whole textbook one by one. You go chapter one, chapter two, chapter three. So if the same way, if you look at first, you need to understand the pattern. You need to understand what it is you need to look for in those areas. That's number one. And then divided it into these sections as we've done here. you can now sort of understand where we are to this turn. And then just just like I've done here, I mean, you don't have to do the same thing, but if you want to do something very similar, feel free. If you then reference what it is you want to look for directly on the chart by looking at the lows, the highs, seasonal windows, if you're an advanced trader, and just keep an eye on it, you can see, look, like I mentioned, me being a seller will be down here. Why? Because that's below the range. I want to see low lows, low highs form, right? So hopefully that's a great, hopefully that answers that question, or hopefully this is a good solution to be able to at least track the turns. Hopefully that makes sense. Okay, so this is the current chart. This is the current market opportunity that at least I'm looking at for. And like I hope you can see from this analysis, you can see we're very, very close, right? We're not there yet. We're very close to where we are. And we was looking for our time frame. I mean, look, it's not like you have to use the 4 hour. It's not like you have to use the 1 hour. It's very simply, what's the objective? What we're trying to achieve, right? What we're trying to achieve here, and by the way, you can see all we've spoken about in the last, I don't know, 10, however long, right, is we're building a market view. And you can see we've spoken about seasonal charts, we've looked at historical price action, we looked at the daily before. The point is there's no sort of set rule of thumb to say, right, you must use the daily, you must use the weekly, you must use levels of support, and that's it, right? The point is the objective is this. However you achieve that objective, brilliant, perfect. But let's go back to that sort of structural talk about, right? So you can see a lot of our attention was spoken to the view. We know what we're going to do in this market, potentially be a seller. We understand the context, which is right at daily turning point. Therefore, the timing at the minute is not correct. We cannot place buy sell trades right now because it doesn't make sense. What goes in between step one and step two is a market plan, right? The point of this plan is what does the market need to do from the point it is right now to the point of you actually placing the trade? What's the plan? What's the price action plan? Let's say, right? And for us, as we just said, we want to see a cycle. Not because we just said so, not just because we like to, not just because for the sake of it. We are looking for a cycle because you've seen historically prices done that. And by the way, if you see that once, 5 times, 10, 20, 50, 100, you see the market does the exact same thing over and over and over. And obviously, I've been doing this for a few years now, so I've seen it. But if for you who are very new and you want to build your confidence, in terms of knowing what it is you need to look for, you just need to have that repetitive aspect to it. If you see, seeing this once versus seeing the same thing 100 times, the difference is confidence. You'll be very, very confident now, seeing it 100 times now that this is the solution. So for those who are very new, I'd highly recommend you do that as well. So going back to that structure, as we said, we spoke about the view, asset class, context, timing. What goes between is a plan. As we just mentioned, the plan is a cycle. Great. What we can now do, let's fast forward. Let's say markets have followed the plan, or let's say the markets have cycled. What we can now do, and by the way, this is sort of the moment that all the things we spoke about are sort of leaning towards or building towards, sorry. Now we can talk about the strategy, right? From the slides we spoke about at the start, for this market to go down, what do we need to see? A weak pound, strong dollar. That's key, right? Number two, we then need to make sure the technical analysis, which is what we've spoken about, is there. Now it makes sense for us to ask that yes or no question of can I place a trade, right? I want to emphasize the point. If you're very new to trading, you see how much we've looked at, how much, what do we call it, work, but you see how much analysis we have to do before we even talk about moving averages, before we even talk about the strategy and entries, right? Okay, so like, look, if you can take anything away from today, I just want you to take this perspective away of, do you know what, the strategy, and actually ask yourself the question: what does the strategy achieve? It just, it's a yes no question. Can I place a trade? Yes or no? Doesn't tell you if it's the right asset class. Doesn't tell you if it's the right timing to place that trade. Just tells you yes or no. And sometimes, and maybe you've experienced yourself, you place a trade that meets all of your rules, and it still goes against you. Every trader's experienced that once. So what's the problem in that situation? Well, it's not the strategy. You met your rules. The problem was we thought the market was going to go in a certain direction, but we were wrong about that, right? So that's the problem. And that's what we need to focus on and solve. And hopefully you can see we need to prioritize that first. Okay. Brilliant. Hopefully this is making sense. Okay. Focus on the bias, focus on the plan. We then focus on the strategy because it makes sense to ask that question. The last point is the exit plan, making sure we use the correct exit plan for the trade you take, if and should you take those trades, right? Okay, I'm gonna ask this question. I've asked this question several times in the webinars before, but just want to add a different twist to it, really. If you were to place a buy trade and let it run, which one would you let run, one or two? The answer number one, right? Of course, right? And why is that? Well, that's because of the context, right? That's because of the context of where you are in the markets, right? And the difference between a very good trader and a very, very, very good trader, right, is all about risk to reward, right? So you want to focus on markets that offer you high risk to reward trades, right? And as we just said, the reason why we focused on number one there is because of the context. And where does context come within our sort of three-step process? Let me just put it up here. You can see context is, again, we talk about context at the very start of your analysis, right? So going back to this pound dollar chart, and I talked about where price may get to just based on the previous size of the previous phase, also the seasonal windows towards the end of March. The point I'm making though is, look, if let's say price does go down and I enter a sell trade, I'm going to let that trade run, right? Because I know the context, I know where we are. This is the start of potentially phase one back to the downside. If I enter here, entry here, stop loss somewhere here, and let's say exit over here, that's at least a 2-to-1, 3-to-1 trade. And as I mentioned, if you have a percentage target, right? If you're an advanced trade and you're on your funded account, or if you're a new trader trying to find a bit of consistency, right? Our metric to gauge progress, right? If there were to be one, is percentages. High risk toward trades is how you're going to achieve that, right? If you have a 10% target or 7% target, whatever it is, you want to try and prioritize those trades where you can make a 2-to-1, 3-to-1 trades, because then you hit your targets a lot quicker. You hit your monthly percentage goals a lot quicker. Brilliant. Perfect. So hopefully went through a lot of theory there, and we spoke a little bit about the actual example on pound USD. But I want to take this first webinar really to sort of nail down the theory of how we view the chart, and most importantly, why we view the chart. Brilliant. Was there any questions? Any questions on anything we've just spoken about in the last sort of 40 minutes there? That's a really good question, right? So why should we look at dollar index first? That's a very, very good question, right? So let's give a theoretical example, right? So let's say, obviously, number one, we look at the dollar, right? Let's say the dollar is very, very strong by 1%. Okay, great. So we know how our benchmarks perform. It's very strong, right? Right, brilliant. That's the USD. Let's say the Kiwi dollar is down by 1%. Okay, so Kiwi is very weak, right? Okay. And let's say we look at pound USD, let's say we look at British pound, right? Let's say it's also down, but it's only down by 0.1%. What's happening here, right? Well, both currencies are technically down, and this is often sort of highlighted and asked, right? Look, if the dollar's very strong, everything's weak against it. Or if the dollar's very weak, everything's strong against it, right? But really get into what is we're doing, right? We're using the dollar as the benchmark. We know our benchmark is performing very, very well. So yes, the Kiwi is, performing doing very less, right? But if a very dominant USD is unable to rally against the pound, although the pound is weak, yes, but the dollar is unbelievably strong. So if anything, that just means the pound is equally as strong, right? Does that make sense? Just give me yes or no, because this is very important. And it's a good question you asked, right? So by understanding what the dollar's actually doing, if it's strong, if it's weak, we then use that strength and weakness to reference how the other currencies are performing against it. The best way I like to ask the question is not about what's the major doing, is how is my major performing against the dollar? That's the way you want to ask that question, right? Let me repeat that, right? It's not what is my major doing, it's how is my major performing against the dollar? Because if I know the dollar's very strong and pound dollar is at break even or slightly down, that means pound is very strong as well. Let's imagine we didn't even look at the dollar. Well, then we would have known pound is strong, right? We would look at that and say, all right, pound is weak. Actually, in reality, it's not. It's also very strong, right? Does that make sense on that point? Yeah, mostly. Someone says no. Okay, that's fine. Trading currencies is ultimately all about trading currencies is all about relative strength and weakness. So it's always you're always comparing currencies to another. Brilliant, 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 brilliant. So, uh, yeah, you certainly can use a percentage change, although that will be a percentage change from the start of the day to the end of the day. So you could have a market that goes strong in the morning, and then in the afternoon it's sort of weak, and then the percentage change might be point 0.2, right? Because from the start to the end, it's not really a massive difference, right? So although these are useful, they're not the be all and end all. I'll definitely look at the bars and just look at the bars. I'd suggest so that's that. How do you determine to take profits? Take profits are always dictated by the context of the markets. I mean, it depends on what you're really looking for, right? Look, if you're in a trade and you're up a few grand, you just could say, "Sure, I want the money." We're here to make money, by the way, right? So if you have enough money on the table, you might just take that and say, "Right, great, brilliant. I'm happy to say that." But yeah, ultimately, to answer your question, take profits always dictated by the technicals. Is there a massive level in the way? Is there a massive moving average in the way? Um, yeah, probably that answers your question. Fundamentals will definitely have a play. I don't want to get too. I mean, to be fair, we could talk about fundamentals for hours and hours, and maybe we will do in another webinar. Um, yeah, look, the fundamentals have a huge part, especially in currencies with interest rates and things like that. Moves with the Fed holding. Um, depending on who you talk to, some say he's very hawkish. Some might just say he's giving a bit of room for this new interest rate. It depends who you talk to and ask. But yeah, look, interest rates will have fundamentals as a whole will have huge impact. But for now, just focus on the technicals. Look, the fundamentals is very hard to apply in a repeatable process, and that's what we're here to do. We're trying to use a repeatable process. Hopefully, you can see the conclusions that I've come to in both the first part and this now some cable. You can see the steps taken is a very repeatable process you can use for any other market. Um, yes, like I said, fundamentals and what the Bank of England is going to do in the Fed is important, but it's something that we can't repeatedly use over and over. So I think in terms of priority, focus on a repeatable process you can use before you actually get into uh, that bit there. I hope that makes sense. Right. Let's just pause in the questions. There's a lot. I mean, look, it's good. It's good to see a lot of questions. Let's just pause so we can finish off with the price action theory. So this will be the last part of the theory that we're going to get into. This, of course, voted in by the advanced group, which is great. We live in a democracy, so we're going to talk about that. Okay, I'm just going to pause on the questions now. Look, it's great to see the questions and definitely give my use them at the end so you can fire across. Let's just talk about price action. So great. So how do we make sense of price action? How do we know um, how do we understand price action? How do we sort of understand, how do we interpret it and how do we use it for our, yeah, how do we interpret it? So first things first, this candlestick, what do we call this candlestick? If you know, feel free to comment. If not, not a problem. To be very frank, the names of them aren't too important. There's about this candlestick alone has about 10 to describe them. But yeah, so Hammond bar, pin bar, yeah, I like to call it a low test bar. Uh, I can see why people call it a doji. Maybe just give this a bit of a lower wick, really. But the point is, this candlestick represents a reversal within that time frame. So let's imagine this is a daily time frame, right? So let's just say easy numbers. This is the first 12 hours, price went down, pushed lower, and then the remaining 12 hours, the buyers come back in and push the price back to the upside. So very simply, it's highlighting a reversal within that 24-hour period, right? Now, the question I want to ask is, why have we created the same price action bar receive three different outcomes, right? And this is a key point to make. The size of the bar doesn't actually matter because they have the same characteristics. Candlesticks are known what to be called fractal, right? They have the same character. It's like a snowflake, right? The structures are the same. You're never gonna have a snowflake that's identical, right? So here's a low test bar, right? Price went up. Here's yet another low test bar. Price went down. And here's another low test bar here. Price went sideways. So ultimately, the question is, how on earth can we have the same exact candlestick, but seeing three completely different outcomes? Any thoughts on this? Don't worry about being right or wrong, just any initial thoughts on why this might be the case? How on earth can we have the same candlestick, see three complete different movements? Right. I think you guys are getting that, right? Um, what I've done is highlighted these two areas in blue. And we'll go from the daily to the weekly, just so I can understand what trend we're in, right? That's the purpose of us going on the weekly here. And you can see price is in a downward moving trend. Very messy in this area here, breaking through this level. But ultimately, we are in a movement to the down. Those two blue boxes highlighted on the daily time frame are referring to two complete different areas, two different locations of this weekly trend. So there's the daily, right? So if I go from the weekly time frame back down to the daily, we now understand what these mean, right? This area is the lower high of the weekly downtrend. So if this is the lower high of the weekly downtrend, this is where we expect to see sellers in this area, right? So it goes back to what we said at the start, right? We want to be able to be forward looking, understand where we are and what we expect to see in that area. And this area here is at the end of phase one, right? So the answer is context. Obviously, we spoke a lot about context today, which is good. So it's less about what bar you're seeing specifically. It's more about where you're seeing it. Okay. So whenever you're going to the markets, whenever you're going to the charts, right, you always want to have an understanding of first things first, where are we in the market? And then ask the question, what what does that price action mean in that context? I mean, if you look at this, go back to cable, right? This looks like a low test bar. Sellers come back in, buyers come back. So, this would be a bullish bar, right? But we understand where it's located. It's in the turning point of a movement to the downside. This actually indicates that sellers are starting to re-emerge in the market, right? Does that make sense? Yep. It's all about, when it comes to price action, is the first priority needs to be, where am I in the market? What's the context of where I am? You can never look at a market, or you can never look at a candlestick and see this and say, right, that must be a bullish bar. Because look, if I said to you this is at the end of an 11-day non-stop buying streak, that's not bullish at all. That's exhaustion. That means the end of the move, right? So brilliant. Perfect. So went through a lot. Went through a lot there. Hopefully it was useful. I think today was good. Majority of today was mostly just to get an understanding of um why we look at the way things are. Definitely myself, obviously, where this webinar has been more about my point of view and how I look at charts. Just want to make sure you understand why use the process, what the process of why we use it. And hopefully today's done that. And moving forward, of course, we'll apply the same process on the markets moving forward. Before we wrap up, I did want to mention I have made a new Instagram account now that we are moved to the city of London. There's a lot of things happening behind the scenes, new event coming up, a lot of things going on. I thought it'd be good to capture the moment, not just the movement that we're doing, but also be doing exclusive Q&A sessions on the Instagram between trading sessions. on Instagram alone and live streams as well. So if you are, interested, give us a follow, and this will be where we get behind the scenes, look things like that. But things that we've spoken about. Any questions? Feel free to drop me a message on Telegram as well. Like I said, this webinar is sort of for all stages of where you're at, whether you're a very big beginner trader or very much advanced trading funded accounts. The process that we should be using should be the same. And and hopefully today's done that. So, like I said, any questions, drop me a message, and we shall catch up hopefully next week, Friday, if all things go well. Brilliant, guys. Have a great afternoon. Have a great weekend, and we shall catch up. We should catch up hopefully next week for another one of these webinars. Perfect, guys. Speak to you soon, and yeah, have a good one. Take care. Bye-bye. Bye. Bye.